welcome. Thank you for attending our landlord webinar. Really appreciate your time and for coming and visiting us today. I'm delighted to have with me Hendry from Foundation Home Loans, Steve Cox from Fleet, Adrian Moloney from One Savings Bank, and Abbie Gaul from Impact Specialist Finance. In a second, each of them can tell you exactly what they do and their job roles in the industry. But in the meantime, we have a list of questions I'm going to fire to them shortly. But also at the bottom of the screen there, you'll see a Q&A button. Please do give us your questions and we'll answer them live as we go through the session. So for the next 50 minutes or so, I've got a number of questions I will ask the guys, all relating to buy-to-lets, HMOs, and I will touch on a bit of bridging as well. So hopefully you'll find this session useful. But in the meantime, can I start, please, by introducing the panel? Grant, can I start with you, please? What is your job role at Foundation Home Loans? And just give us an example of the market you serve.
Absolutely. So yes, thank you very much. Thanks for this opportunity as well. So yeah, my name is Grant Hendry. I'm Head of National Accounts and Sales at Foundation Home Loans. We are predominantly a buy-to-let lender. We've been in the market since 2015, trading under the name of Foundation Home Loans. Yes, that's predominantly our marketplace is buy-to-let, portfolio, limited companies is our bread and butter, really.
Brilliant. Steve, over to you.
Well, thanks, Dale. Steve Cox from Fleet Mortgages. We're an intermediary-only lender, working with our partners such as Impact, and we are buy-to-let only, so we're looking across standard limited company and HMO multi-unit block part of the market.
Thank you. Adrian?
Yeah, hi, I'm Adrian Moloney. I'm Group Sales Director at One Savings Bank. I head up the sales proposition for Precise Mortgages, Kent Reliance for intermediaries, and Interbay Commercial. Like the guys, focusing on everything specialist in buy-to-let, but also we deal with commercial, semi-commercial, and short-term lending or bridging through our brands as well.
Brilliant, thank you. And our very own Abbie.
Oh, yeah. I'm Abbie Gaul. I'm a advisor at Impact Specialist Finance, whole of market broker. However, I tend to specialise in assisting buy-to-let landlords with acquiring properties, refurbing properties, incorporating portfolios, and HMO purchase and refurbs.
Excellent, thank you. And staying with you, Abbie, hopefully most of the people on here know what a buy-to-let is, but for those that don't, can you just let me know, how you get involved in the buy-to-let side? Should someone with some spare capital invest in property on the buy-to-let sector at the moment?
In terms of mortgage finance, so generally speaking, I think it'd be fair to say the sweet spot on buy-to-let finance would be at 75% loan to value. So needing 25% deposit. One of the benefits of obviously buy-to-let purchases is that you can borrow to acquire a property. Rates would tend to start as low as probably sub 2%, and then ranging through depending on how specialist the property is. For example, HMOs, multi-lets, and some of the more specialist complex sort of properties.
Brilliant, thank you. And Adrian, there's a lot of talk about funding in the current climates. How are One Savings Bank funded? How are you coping? What's the outlook at the moment?
Yeah, no, it's pretty good for us. We are funded by retail deposit, mixture of retail deposits, and obviously we have the opportunity to go to the money markets as well. We're a sizable bank, combined two banks last year, OSB, which is One Savings Bank, and Charter Court Financial Services, which own the Precise brand. So, we're probably one of the bigger players in the specialist buy-to-let market, as well as a result of that. But we don't probably see many of the funding challenges that perhaps some of the, I guess, non-institutional lenders have done over recent months. But funding is pretty strong. But you're seeing various lenders getting away mortgage-backed securitisations, which is great for the market because it keeps competition for the landlords. I guess from the point of view of having a big player like us in there, we add some stability. And I think quite a lot of credibility to the specialist buy-to-let lending market.
Brilliant. And Grant, what about yourself? What about Foundation?
Yeah, so we securitize. So it's the only way in which we fund ourselves. So basically, one of the big things for ourselves off the back of COVID, and as Adrian said, that there was a little bit of uncertainty in our market before But actually, we've seen great confidence. The comeback has been very strong for us. And one of the key parts of what we do is we have a warehouse. So the way in which that warehouse works is we will put the loans into there to start with before we securitize. So you want to get your pot up to around about 300-400 million before you then look to do a securitization. But we had a successful securitization back in July. And the speed in which that came back off the back of COVID actually shows great confidence in the housing market. So actually, we've, as I said, focused on growing that warehouse. So we've now taken that to over 1 billion. Which then really helps us to ride out any volatility that may be. We haven't even touched on Brexit, and that hasn't taken its full impact. But by having a warehouse of the size in which we have allows us to avoid that volatility. So actually, from where we're sat, it's looking very good from us from a funding point of view. Investors,
you got money to lend. Okay, and Steve, what about yourself? And have you seen recently, tell us about your funding first of all, but also have you seen one of the questions submitted to us before the event was, do you think the market has slowed over the last few weeks?
Well, I'd probably take that one first out. We haven't actually seen any slowdown at all. The numbers and volume of business still incredibly high. I think the SDLT incentive obviously has a part to play in that. Our mix has risen slightly towards 40% now on purchase. It would normally run at 30. So clearly investors are taking advantage of the incentive with stamp duty. But yeah, it certainly feels very different to the start of lockdown 1, when, as Grant mentioned, the capital market sort of shut down overnight. There was an issue with funding. But just as quickly as it closed down, it picked up again in the summer. So yeah, we are a non-bank lender as well. We don't have a balance sheet, so our money comes from the capital markets. We currently have 2 active funding lines with a common set of products. And I've got to say, really, since the summer, the investors and funders out there in capital markets have been extremely positive, both about the UK housing market as a whole, and buy-to-let in particular. So I think that does bode well for investors out there going into next year. What happens to volumes should the drop dead date occur as planned with stamp duty, we will see. But with a very, very healthy mix of remortgage business from our point of view, it seems to be a case that, you know, I think the macroeconomic underlying factor here is people have got to live somewhere. There isn't really a social housing policy in the UK per se. So more often than not, people are going to end up in the private rental sector. So the funders are positive about it. We're positive about it. And it looks like we could be hitting the perfect storm for buy-to-let to thrive into next year and beyond.
I think, Dale, just on the back of what the 2 guys said there is, you still have a number of institutions and lenders wanting to come into this space, which tells you where the opportunity is, because, you know, it's pretty crowded. There's a lot of choices I'm sure Abbie will come on to for her clients and where you place them. But there are more lenders coming to market looking at trying to get into this space, which I think means it's still going to be competitive in, as Steve said, in 2021.
So it's a good time to be a landlord. That's what you're saying. And
yeah, I think so.
Yeah, absolutely. And you mentioned stamp duty there, Steve. The reality is obviously the deadline's, you know, is just around the corner, but actually solicitors are quite behind in completing deals. There are some rumours that searches that have to be done on properties are weeks behind. It was even a conversation that someone mentioned there could be 100,000 deals that actually don't meet the deadline. Is that a reality, or are we just speculating at the moment?
I think the reality is there will be a tipping point where the clock will be against investors trying to get deals through if the stamp duty holiday ends as planned. From a lender's point of view, we will keep doing what we do, and the guys, my colleagues on the panel here, to get the business process through to offer as soon as possible. One of the main sticking points that we have in that chain as lenders, period, not just Fleet, is the ability to get valuers out quickly. Now the valuers went back out during the summer, God bless them, And of course, it does take longer. I think everyone recognises that, particularly with the health and safety protocols that they have to put in place. But it's not that probably isn't going to elongate it to get it through to completion. There is a problem with the solicitors and conveyancers of the world, and as you referred to, Dale, the varying times it's taking local authorities to get searches back. So I think everybody is pulling in the same direction, but realistically, there is going to be a pinch point that hitting the deadline may not be possible. I wouldn't like to say that it's now, maybe it is as we approach Christmas, just into the new year. Realistically, if we look at the time business generally will take to complete, yeah, after Christmas, particularly on purchase, it could be pushing it to get it through, but it isn't necessarily the lenders that are going to slow it down. I think it's everybody else in the chain.
Yeah, I agree with that. Adrian, Grant, anything else to add on that?
I think Steve has hit the nail on the head. I mean, you know, I think some of the headlines around the searches have come out around Hackney in particular, where I think there was a cyber attack of all things, which has slowed it down there. I think there are elements, lenders on remortgages will look at potentially search indemnity. But, you know, I think anyone who is looking at March the 21st as a deadline needs to consider how they start the process now, because this is going to come around remarkably quickly. So, you know, I look at our own business. Fortunately, our service is, I think, pretty good. 2 or 3 days to application. If the documents are provided with that application, like the likes of you, Dale and Abbie, and your business provide us up front, we then take about 4 to 6 days to get the val back, and the offer is out in on average a 2-week period. So that's the first part of the process done. The key bit then is the property in a chain? If so, that becomes a little bit more difficult because it can be held up. And to your point, you know, making sure that you've got a good conveyancer. I think probably all of us, certainly at OSB, we have, if you're doing it in a limited company, we have to have our own solicitors acting for us as part of that process. So 2 solicitors engaging, that often takes up time. But in the main, I think the market's held up quite well to now in terms of the supply chain. The big bit, and none of us know the answer to this, is, are we going to have a cliff edge of the 31st of March and that is going to be the end of this stamp duty? Or do we see it being extended? Because one bit you've got is that, you know, the Chancellor will do everything he can to keep the economy going. And this stamp duty piece, as Steve has said, particularly in buy-to-let, and I guess for first-time buyers, has put some impetus into the market. And they won't want the wheels of that falling drop dead on the 1st of April. So I think this has probably got a little bit to run out. And you've certainly seen some of the industry trade bodies lobby the government to extend that date, Dale.
I think it is causing, on that point, it is this falsifying the economy though as well. And what we're seeing, there's almost 2 economies built off the back of this, with the stamp duty and everything that's going on there. And from what other research, when you look at it, actually, if you didn't buy a property within the first 2 weeks, you're not necessarily saving yourself money. I think it's about what you're actually buying for. So if you're incorporating, or if you're doing a remortgage, capital raising to buy another buy-to-let, that window's quite tight. With Foundation, we're taking it very seriously to make sure that we can do everything we possibly can to make sure that customers are able to complete by the 31st. But from a landlord's point of view, now is a great time to be remortgaging, capital raising against their property. House prices are very stable at the moment. So if we do get to the 31st, if we do then fall into a situation where house prices drop, what we're finding is landlords are now more geared than they've ever been before to positioning themselves to be looking to buy in the future. So come the 31st, if there is a drop, that's when landlords are then going to look to buy, rather than trying to do it all now when the stock may not be there in the same way. So I think that where we're positioned, landlords, because I'm going to take a step back. If you go back to 2007, 2008, the recession was caused off the back predominantly by what lenders and banks were doing. Now we're in a position where we want to lend. The market is strong, the market is stable, so that can still sustain and stay at the same level. So I don't think there's going to be a sudden cliff edge. I think what you're going to find is landlords can keep buying as long as the stock is there for them to be buying. So
yeah, but Grant, the cliff edge I was talking about is the hard stop in terms of the date,
yeah,
rather than a
yes,
fall off a cliff in terms of house prices.
Yes, yeah.
Okay, and whilst we're on that sort of subject, Abbie, are we seeing the end of the single buy-to-let owner, or is it all professional landlords now, or are you seeing people coming out for first-time landlords and investing in properties for the first time?
There's certainly still first-time landlords coming to the market. I think the difference from maybe 5-10 years ago is maybe the more professional approach that landlords are needing to take. So making sure that they understand the tax implications of buy-to-let, which have changed dramatically in the last 5 years. And just some of the complexities regarding the mortgage finance. So whereas previously you may have always been able to gear in the southeast at 75, 80% on a single let property, some of the changes with the rental calculations mean you need to look at the mortgage finance slightly differently, and it's put a real shone a torch really on property yields. And rather than just looking at property because it happened to be close to the station and what you perceive to be a great buy-to-let fit, really focusing more on the numbers. And certainly there's a more professional approach, but certainly first-time landlords are still coming to market.
You mentioned divides there. Are we seeing a north-south divide? Are people buying a lot more properties up north because the rental yields are better, or is it still 50-50?
Well, we're based in the southeast, so previously my client base has always been very southeast driven, and properties in the southeast. Certainly, we've seen more landlords looking at properties in the north, but I think it's not always yield chasing either. That can be a misconception. I think you really need to understand the market that you're purchasing in, the tenant profile of that area, and really get to grips with that. So simply chasing property because you can purchase it cheap and it's got a yield of 18%, it's not for everybody. And I think it's really, once again, focusing on the numbers, the risk appetite, and where you are as a landlord and an investor.
Steve, what about fleets? Are you seeing that?
We are seeing a little bit of that. Abbie's absolutely right. It comes down to the individual and their appetite to diversify a bit further afield. But we are seeing a number of landlords, perhaps where they've traditionally got property and portfolios London South East and have enjoyed capital growth for a number of years. We are seeing some diversify further afield, Midlands, Northwest, for yield. So it's just really trying to balance a portfolio. But Abbie's right, it isn't for everyone. It isn't a given that is the right thing to do. It's down to the individual landlord and how they feel about, putting it bluntly, taking on an investment out of area.
And Grant, we've seen obviously the properties being bought up north sometimes, like the guys have said. But what about sort of loan to values at the moment? We've seen the loan to values creep back up to 75, 80, even there was an 85% out for a while.
Yeah, I mean, LTV and ICR is king for lenders, especially in the securitization side of things. So for us, that appetite to go further afield is not the direction for us. For us, we want to diversify. We want to be doing more business outside of the south, because exactly the same from where impact are based, from where fleet are based, predominantly that's where you get your business. That's where your sales team are. That's where your underwriting team are. And that's where you're going to attract those initial brokers. But yeah, for us, that cap 75, 80 is really the maximum I'd want to see in the buy-to-let. The ICR often impacts what you can go to anyway on how much somebody can physically borrow against that property. So,
Adrian, Kent Reliance used to have an 85% loan to value. Not at the moment, but is it something that's on the horizon?
Well, I think what you generally see is when people go up the risk curve, they're probably not doing enough business, Dale, for what they want to do, and that's where you see people creeping up, or some of the lenders dipping into the higher LTVs. I think Grant raised a really valuable point there. I think most of the ICRs support loans around 75% LTV. I think there is still a little uncertainty about house prices. I mean, it is quite hot at the moment, but to what the two guys said, to point on perhaps some of the stamp duty bit fueling that. Most landlords that we see tend to have several buy-to-let properties. The 25%, as Abbie said, doesn't tend to be an issue in terms of the deposit. So do I see 85% coming back? Someone will probably do it, Dale. I don't think we're in the place where we need to on buy-to-let at the moment, so I don't think you'll see it coming out of our brands, any of our respective brands in the near future. I think it will be interesting to see where that goes, because I think most sensible lenders will want to see what happens post a Brexit or non-Brexit trade agreement, and what happens as we come out of the back of the pandemic as well, and where property prices settle down probably in the spring.
It also affects service, doesn't it, at the moment? And service in the current climates is of very much importance to us, especially with regards to getting back to clients on time. Abbie, what are we seeing with regards to delays with lenders across the market at the moment?
I think it really varies on lender, and I think this is where it's sometimes rate isn't always the most important thing to be looking at, especially if you've got a purchase with coming up against the stamp duty deadline at the moment. So some lenders are great in communicating what their turnaround times are, and if they're sticking by them, then we know what we're going in for. And I think communication is really key. There are some lenders that have got pretty lengthy delays with them at the moment. I think the biggest delay though is coming from conveyancers and getting the legal side sorted. This morning, in actual fact, on one of Adrian's brands with Kent Reliance, they actually have their solicitor instructions available, so we're not waiting for the offer to go out. We can actually get them out to the legals ahead of offer. So those kind of things helps well with lenders. I think though, getting a really experienced solicitor on board for any purchase business is going to be, and someone that knows the lender is going to be a really big benefit for being able to get stuff completed before that March deadline. But yeah, there are delays with lenders across the market, I'd say.
I think you're spot on, Abbie. I think that solicitor piece and having somebody who knows the lender, knows the market, especially in the buy-to-let specialist space, we see it so often where someone uses a solicitor they've used for residential, and it's a friend of theirs or however it might be, that relationship. To use someone who isn't an expert in that side will often be the reason that something might not go through. It might fall short reasons, or we see it where it comes in and then the certificate of title hasn't been completed correctly. And that just causes unnecessary delays. So using a solicitor at the forefront, instructing them, explaining what you're doing, the lender, getting them in contact with us, yourselves, really makes a big difference to those cases going through.
And still staying on the buy-to-let side before we move on to HMOs, but we've seen a lot of clients and possibly a lot of limited companies who have taken bounce back loans or mortgage payment holidays because it was encouraged at the time to take the holiday and so on. How do you look at clients who have taken those? And obviously we're going through the next phase of mortgage payment holidays and so on. So how do you look at clients who are applying to you to do another buy-to-let when they may have taken that in the past? Steve, do you want to take that one first?
Yeah, so if I take that question to Dale, our approach on using bounce back loans as a deposit is we won't accept that. That's after lengthy consultation with our funders. I suppose, putting it bluntly, not 100% lending per se, because of course the bounce back loan isn't secured on the asset, but it is understandable that funders would be reticent to accept that with no skin in the game personally. So our position on that is clear. We won't accept the bounce back loan as a deposit. In terms of payment holidays, providing the payment holiday has been capitalised or repaid, customers are subject to normal underwriting. So we don't hold it against customers. That would be the wrong thing to do. If we take a step back, I actually wish that it hadn't been called payment holidays. I wish it had been called payment deferral or something along those lines. The way it was kind of put out there was a holiday is supposed to be something you should enjoy and have. It's great. Not that we've had enough of those this year. And I think we did talk to a number of customers. We service the book of loans, even though it's securitized. So we have regular contact with our existing customers. And I think once customers realised that there could be implications with other lenders in the market, that interest would roll up on it, it's going to be paid at some point. Some people didn't take it, or those that had even repaid it quite fast. But yeah, I wish with hindsight the government had positioned it slightly better than a holiday.
Grant?
Exactly the same position for us. I think we look at each case on its individual merits. We won't accept a bounce back loan. That wasn't what it was there for, to be used as a deposit. That was there to protect your business and to cover you from there. So we won't be allowing you to use that as a deposit for an onward purchase. And the mortgage payment deferrals, exactly the same. We managed our book in-house for existing customers, and that really put us in a very strong position to be coming back into the market sooner. And actually what we found is professional portfolio landlords weren't the ones who were taking it. At first, they jumped on it because they thought, oh, this is a chance to hold back some money to then buy another property. But as soon as we said, we don't like you doing this, it's not what it's there for, straight away they paid it. And that put us in a very strong position because we had to fund it all ourselves. So yeah, it's actually, I've been really, really impressed and proud of how landlords have handled it and not taken advantage or just misinterpreted it at the beginning. So that's put us in a very good position. And for that reason, for those landlords who are on this call, thank you very much for not abusing it really, because it could have really impacted us quite hard.
Okay, good. Adrian?
Yeah, look, we as lenders now have, excuse me, a bigger understanding of that. With if you want, I guess, deferrals Mark 1, we were all caught on the hop and told to do it within 24 hours notice. And I think that was, for clients, to what Steve said, was, you know, they saw it as a holiday and didn't understand the full implications. I'm sure Abbie and yourself in your businesses had to explain what the implications were. We look at each case on its individual basis as well. It's the right thing to do. And I think, like most lenders, we've seen a reduction in the requests for those. And also we've seen people pay them back. So I think that this time around, there's a better understanding for the market. But, you know, as a bank and as a client who, as people have clients on our balance sheet, we were more than happy to help out our clients who genuinely needed to take a payment deferral at the time. I mean, we're probably quite fortunate that we didn't have to stop or pause lending during that period. Our funding model allowed us to continue through that. But look, I think the whole market has a better understanding of how these work now. And, you know, I guess putting them in place for another 6 months is there to give the market the reassurance that if we have a bumpy ride over the next 2 or 3 months, that whether it's landlords or mortgagees have the ability to speak to their lenders for some support if they need it.
Yeah. And Abbie, how have you found clients taking bounce back loans and payment holidays and bits?
Very much the same as I think Adrian just mentioned. There's certainly a Mark 1 and a Mark 2 of it. Mark 1 back in March, no one knew what was happening with COVID. It was all very new. There was an opportunity maybe to build up a buffer of funds because no one knew if they were going to have tenants, those tenants were going to pay, all of those kind of things. And it was a case of managing it, explaining it, and the rest of it. In terms of coming out of that now, I'm dealing with a number of lenders on underwriting who have taken a pretty good approach, seeing that they've taken the payment holidays, the accounts are all up to date, the reasons they took those payment holidays, and lending very responsibly. I think clients, from my experience, that are now taking payment holidays now, where there's a bit more of an understanding of where we are with the COVID situation, are taking them because, in actual fact, they require them because their tenants may have left, or in actual fact needing to call on them, which is what payment holidays have always been there for. I agree. It was a bit of a Boris statement of everyone can have a mortgage payment holidays, and just making sure that you understand the implications of that, especially when you come up for refinancing, because the interest will have been capitalised. So at some point, unless your property's gone up in value, that needs to be taken account of as well.
Staying with you, Abbie, as you mentioned values there, valuers at the moment, are they down valuing properties? And what are the delays at the moment?
I haven't seen valuers down value properties, I think, at all, really. There's always on a purchase, I'm seeing valuations generally holding up where the purchase market is. On refinance, I suppose it's always a question of where you believe your property is valued at, but no, I don't see a general down valuing of properties at all. There's certainly delays with valuers getting out to properties.
What sort of timescales?
I think we're looking at probably between 7 to 20 days to get valuations booked in. On just standard buy-to-let kind of transactions. With bridging, there's always a lot more adaptability of being able to get a valuer in, have a ring around, and make sure that they're delivering on time. So it's a bit more flexibility with the bridging lenders.
Okay.
On that point, Al, of the timescales for the valuers, so we're working with all our valuation partners on the panel. And it does vary firm to firm because, of course, some of the firms are flooded with residential volume from high street as well, others less so. So it's a case of working with our partners to make sure we get the right valuer out to do the right job in the quickest time possible. There are delays, and that isn't going to go away. We can't get around that. But I think everyone in the chain, be that us as lenders, impact brokers, and customers, they understand there's going to be delays. It's not an ideal environment to do this. But for us, the most important thing is actually the surety of getting the job booked, even if there is a delay. So it's not disappearing into a black hole from a customer's point of view or a broker's point of view, where the business is processed and then nobody hears anything. So even if the job is booked in advance, what we're trying to do is work with our partners to make sure that outbound phone calls made to the agent if it's a purchase, or to the landlord if it's a remortgage, to get the job booked in, so everyone knows it's still processing through. We're still processing the case in the meantime, so it's not a delay. We're not waiting for the valuation to come back. It will take longer, but there's things we can all do to try and shorten the pain of the environment that we're working in.
That's good. Grant, Adrian, anything else to add?
I would just say, following on from what Abbie said, that we're not seeing down valuations at all on the purchase side. That's definitely not coming into it. I think value is always going to be concerned and protect their PI as much as possible. But from where we're positioned, we're looking. So we use Connells for standard valuations, and then we use appraisers for multi-unit blocks, HMOs. And for a standard through Connells, you're looking around about 13 days. So it's 4 days to instruct it, and then from there, 9 days to carry out the valuation. The valuation, they're targeted with Connells to get their reports back to us same day as carrying out that report. And when they're going into a house, it's not just a straight go into the property in and out. They have to put their PPE on. There's so much more: booking the appointment, getting the keys to view the property. If it is a HMO, everybody's got to get out, all the windows got to be open. So we've really got to have a lot of respect for what valuers are doing at the moment, to be going out and to keeping our position. I know, Adrian, I don't know if you do desktops or automated valuations, but for ourselves, with the physical valuation that is essential, they are really the unsung heroes, keeping our lights on and keeping us in a position to keep lending. So it's great that we have their support and buy-in. So just be patient, but as everyone has said as well, do your bits at the beginning. If you want to instruct that valuation before, just put a note on the case that the broker can help you with that. And that can happen. That's taking a risk on your part, but it will speed up the process as well if you wanted to do that. So it is an option, but it will come at your cost if the property if it falls through for whatever reason.
Okay, and moving on to houses of multiple occupation, HMOs, Abbie, what are they, and are they specifically drilled towards the millennial age brackets?
An HMO, I think, is defined as a property, a house of multiple occupation. So 3 or more households sharing the same, let on a room by room basis. We have seen a massive increase in HMOs, and the yields on them can be pretty good. But yeah, it would tend to be a multi-let situation with shared kitchen, lounge facilities. But we have seen there are some very nice HMOs out in the country at the moment. So yeah, possibly a millennial thing.
Adrian, have you seen an increase in HMOs this year?
Yeah, I mean, we've just expanded our criteria under the Kent Reliance brand to do 7 to 10 bedroom HMOs, just as demand has driven us to do so. I think HMOs. I think you do need advice when you look at HMOs. Is it the right asset class for you, and advice in terms of the mortgage that you take, because it is very different from owning a 2-bedroom flat. And some of the costs and the uphold, etc., that go alongside that. We tend to see HMOs being bought by experienced investors that play in that market on a regular basis. To Abbie's point of view, I think every millennial demands a Premier Inn in their in a house of multiple occupancy, or that sort of standard of accommodation, and it's very the standard of a HMO or a multiple let compared to what it was 10, 15 years ago is considerably different, and the type of tenant you get in there demands a different quality of asset and the way in which it's upkept. So I think you'll see HMOs continue to grow. You're still seeing, despite a pandemic, more people going into higher education, so good demand in student towns. But I do think it is, make sure you know your stuff before you invest in more complex property, is what I would say.
Steve, what should they be looking out for? What should buyers look out for? What are the challenges with regards to HMOs?
Well, I think I'd sort of echo some of the points Adrian's made there, in that it isn't for everyone. It is more complicated. If it's not an asset class the landlord's used to, they need to take advice on it, look very carefully about the market, particularly if it's out of usual area. Again, we have seen an uptick in HMO business this year. It looks set to continue. Go back to the point I made earlier, and people have still got to live somewhere, regardless of the economic climate that we're in. But yeah, I'd agree with Adrian wholeheartedly that people are still going to university, and therefore the demand for that kind of property is still going to be there. But take advice and think carefully before piling into potentially the wrong one.
Abbie, what else to add on that? Larger properties, are you seeing more than 8 beds, more than 10 beds?
No, there's certainly demand for those larger HMOs, and I think with those larger ones, there's more management involved, there's more planning restrictions involved and planning applications involved. So you will tend to see lenders wanting more experienced investors taking on those larger properties. I think with first-time landlords and smaller investors, they tend to be looking at the up to 6-bed sort of properties where the planning restrictions aren't so onerous.
Okay, and Grant, one of the questions submitted before, can a buy-to-let mortgage be changed to a HMO at a later date?
Yeah, it can. Obviously, I think the most important thing is that you go and you get the permission from the local council for the license that you may require. But yeah, there's no reason why you can't change a standard house. But once again, seek that advice, because every council is different on what their rules are around what they class as a HMO, what their requirements are. But absolutely, by all means, change your house if you need to change it to HMO. But you obviously need to make sure the regulations are met.
Absolutely. And another question, should I put off purchasing an investment property until after March 21? Grant, again.
Personally, I would say yes. I would say don't put the pressure on yourselves at this moment in time to be doing it. I would be making sure you've got your money, you've got everything else in place, you know where you want to buy. Use this time to be looking at where you want to be investing, what you want to achieve from it. Are you looking to create income now? Are you looking to buy a property that's going to hopefully grow in value? Are you looking to build an estate for your family? It's all about what you're looking to do, and use this time to purchase. If you're buying and you're saving yourself £4,000, you'll probably be able to save yourself £15,000 by buying after the 31st of March. So I personally, if I was buying, I wouldn't be buying today right now just because of how tight deadlines are, and I wouldn't want to miss it and that disappointment, especially if it's associated to a chain and everything else that's happening. But if you've got the time and the effort to put into it, maybe I'll pick something up. But yeah, I personally wouldn't buy right now. I would be waiting until 31st of March.
Steve, what's your thoughts?
I'm not sure I agree with that, Grant. I think if the deal works, the deal works. So yeah, there is the obvious incentive that's in there in terms of will house prices fall? Who knows? There's so many moving parts for that. So what kind of COVID environment will we live in 2021? Let's hope it's better than 2020 or where we are currently today. Brexit comes into it, as Adrian mentioned earlier, but you know, maybe there is some kind of house price correction at some point. We are in a bubble. There's no question about that. But I don't think we've got indications that prices will crash to the floor. So my view would be slightly different in that if the deal is right now, yeah, okay, there is an incentive there on stamp duty today, but if it works, it works.
Adrian, same question, but I also want to load it in that if you did buy a property, would you then buy it in personal name or a limited company name?
I'm qualified to give mortgage advice, but I'm not licensed, Dale, so I'll leave that to someone who is qualified in terms of tax advice, because I think that is really important to go hand in hand with the mortgage in terms of the structure that you decide to put your buy-to-let in. I'm probably with Steve. Look, there's 4 months to go to the end of stamp duty. Stamp duty isn't the driver for every investor. It might be part of it. Certainly where I live, the £15,000 is probably swallowed up now by how house prices have inflated since it was introduced. So that might not necessarily be a driver for someone around here. But it will all come down to if you can make the deal work. And look, you know, there are other options to buy before the end of March rather than a standard buy-to-let mortgage. I'm sure Abbie could touch on the benefits of being able to bridge a property, which can be done really quickly with the ability then to term it out at a later date. So I think that if you can make the numbers work and you can do it in the time scale and it's something you really want, I think there's still good opportunities. I'm kind of with Steve. Look, you know, we talk about house price correction, but, you know, none of the three of us, I don't think, are economists, are we? The last time I looked, we weren't anyway. So, you know, predicting where house prices go, I've been trying to do it for the last 10 years and have been about successful with it as I've been with horses. So I think that there's, you know, if you pick the right opportunity, you get your funding right. I still think before the end of March, there's still plenty of time to pick up a good asset.
All right, Abbie, I'll fire that question to you with a different angle then. Are we seeing an increase in people buying in a limited company compared to a personal name?
Why didn't you give that to me, Dale? I could have answered that one.
Come back to you in a minute, Adrian. I've got another one for you.
Yeah, certainly in the last 5 years, there's been an increase of people buying into limited companies. I wouldn't say there should be, it's certainly not my position to advise whether to buy in a limited company or not. I can certainly talk through the advantages from a mortgage perspective of a limited company, but there's disadvantages as well. So you'll tend to have a higher rate within a limited company. And from a tax perspective, it's certainly not for everyone. And I think it's really important to get that professional advice from the outset. And I think it comes back to having the right professionals around you. So getting that tax advice before you commit to purchasing the legal title, getting the right solicitor in place, and clearly getting the right mortgage advisor in place, just to get all of those bases covered and get the right professional advice.
Fair enough. Adrian, back to you. So another question that came in before where we started: what actions might lenders take if borrowers are found to be in breach of their existing mortgage terms by transferring the beneficial interest of properties and lending into a limited company without advising the lender?
Well, if you're in breach of any of you, if you're in breach of any of your mortgage terms, a lender is entitled to call in that loan. We actually have a process where people are able to transfer from sole name to limited company as part of our process that we offer to clients. So, you know, what I would always encourage people to do is to do things properly, because what you don't want to do, and I'm sure Grant and Steve would be the same, is to be in breach of any of your covenants, because worst case scenario, any lender that finds you've done that, the first bit they can do if they want to is to call in the debt.
Good response. Grant, anything to add to that?
I think Adrian was spot on.
Okay. And are we seeing a lot more, I mean, especially around Horsham Way here, we have a lot of offices that are now going to be remaining empty, having been vacated pre-COVID, and we're starting to see developers already putting in planning permissions and so on and so on. Is this going to be an ongoing trend moving forward, do you think? Adrian, back to you on that one. Converting into flats, sorry, office space converting into flats.
Yeah, look, I think it's pretty common where I live in Epsomdale, and literally there is a road which was offices just on the outskirts of town, all being converted into flats, and some of it's student accommodation because there's a large student population there. I think you will see more of that. I think, interestingly, the whole pandemic bit has, as I guess, certainly 3 of us, I would imagine, are working from home here. I think Dale and Abbie may be in the office, I might be wrong, but has encouraged more home working, and I think you may see a mix of that going forward. But look, you know, I think what you will see is some, for people looking to take office space, some bargains, because the premium to pay for those leases will probably come down as a result of more businesses looking at more agile working and the way in which they work. But yeah, I agree with you, Dale. You certainly, no matter what town you go in, you certainly see more people or more developers looking to convert office space into what is quite often high-end apartments or high-end flats.
And with that, we're seeing quite a few, even new builds, are adding cladding onto the external fascias of the building and so on. And of course, cladding at the moment is a massive part of all of our day-to-day entities, especially with regards to EW1S forms. And I've seen the government have sort of stepped in over the weekend and said they're going to really relax the issues in bits. But have you seen restrictions on that recently, Grant?
Yeah, we've had issues with it. From a specialist point of view, we became quite hard on the EWS1 forms. And it was more just the governing around where we were getting the information from. So we were having fraudulent EWS1 forms coming into us as well on certain blocks, and that really impacts us. So that's where the nervousness then comes. But I think that relaxing it will certainly help from where we're positioned. But yeah, it's just something we just got to be more wary of. What would be great is if there was a system where we can go, where there's one-stop shop where we can go to and check that it has been done to the right standard of what our expectations are, because we just don't want to take on a property as a landlord, because you wouldn't know yourselves if you're buying a property and that hasn't got the correct forms in place, you wouldn't be taking that on where it's then no longer mortgageable. So I think it's really important that those checks are all done, and to have that central database would make life a lot easier for us. We got
told there's something like 1.6 million properties that are outstanding the correct certification by about 60 people that can actually sign off the EW1S form. So yeah, something had to be done. Steve, have you come across that?
Yeah, we're in much the same place as Grant. I think the only solution is continued government intervention. So it's clear for all of us here, whether lenders, brokers, or landlords. So everyone knows what they're getting into. Without that, I'm afraid it's inevitable. It's still going to be a bit of a muddle.
Yeah. We've had a question come on the system. In view of the situation regarding tenants defaulting, I've decided short-term to do holiday letting in one property in Cornwall, owned by my limited company. Returns are much better than AST lending on a shorter term window, but will this have an adverse impact on remortgaging via anyone on the panel? Grant, to start with you on that one.
Yeah, I'll take that loan all day long. We do short-term lets. For us, I think with the staycation and all of those things, we're certainly seeing demand for it. So yeah, it makes perfect sense that if that's the direction, and the way in which we assess it is if it is a standard buy-to-let. So in the future, if you did want to convert it back to a standard buy-to-let, you have that flexibility to do so with it. So for us, we want to be able to accommodate customers who are going to have people coming in to the properties, staying there for a weekend, for a long week, or whatever it might be. That works really well for us. So we've even got members of staff who have gone to stay in different parts of the country, and they're doing exactly that because they want to change scenery and they wanted to go and base themselves from somewhere else. So I think from a landlord's point of view, it's a great way of diversifying part of your portfolio, creating greater rental yields, and offering that flexibility for tenants. So,
Adrian, do you want to add to that?
Yeah, look, it's something we're looking at. I tend to look at holiday lets as more of a commercial proposition. They're quite often done within a trading business. You know, I think we assess normal buy-to-lets on the basis of an AST because that's the way in which they're let out. I think, you know, a prudent approach when you look at holiday lets is to look at the potential gaps in terms of the voids when they're not let. You know, to Grant's point, I think you probably with a staycation, it's normally down on the coast, and I don't think they're always let out over the course of the year. But look, I think it's an interesting market. I think it, you know, depending how vaccinations go, I think holiday lets could be a big part of most buy-to-let lenders' businesses going forward at some stage.
Abbie, with regards to bridging, people think it's really expensive. And we've seen costs come right down over the last sort of 6 to 12 months. You're having a lot of clients in this area. What are you seeing at the moment?
I think bridging's expensive if you are comparing it to a standard mortgage. It's a completely different product than a standard mortgage, much the same as if you were comparing a limited company HMO mortgage to your 60% residential mortgage. You know, they're very different products. Bridging's fantastic in terms of doing refurbs, maybe purchasing property that's not in a lettable condition, where you're looking to improve the value of it. And it also would have the benefit of no early repayment charges. So as soon as your works are completed, then you would be able to refinance out. And if you're looking to draw down further capital on a completed project. So yeah.
And what sort of rates are you looking at the moment?
Well, bridging's done costed on a monthly basis. So you'd be looking at anything from 0.48 per month through to up to about 1%, really depending on the client and the project experience they've got. It's priced on a monthly basis simply because it's not anticipated that you're ever going to have that in place for a long period of time at all. So yeah.
Do you think we'll see more of it with the run up to the stamp duty deadline to help out clients who might be stuck with normal lenders?
I think you've got to make sure that you are not. So yeah, bridging's fantastic in being able to move quickly. There is a danger of focusing too much on this on the stamp duty and taking out bridging finance just to get yourself that saving on stamp duty, which in actual fact may not be the best advice. So yeah, it needs to be right, and I think that's where the advice is important.
Very good point indeed. Another question's come in. We have a consent to let with Barclays on a property for the last 6 years. We're remortgaging this property. Should it be a buy-to-let now? Steve?
It's one of those ones where you need to know more about the individual circumstances of the case, but it's something that is fairly common in the market where people have a mortgage that was residential, consent to let is granted. It really is something that needs to be reviewed with the right advice, perhaps when somebody's looking to remortgage or at the end of the current deal as to how should that fit in next. But as this has always been there, but I think it's probably more and more common these days. It's something that we would look at taking on, obviously, as a buy-to-let lender. But the individual just needs that advice at every point in that process and journey to make sure that they're getting the right mortgage to sort those circumstances.
Excellent, thank you. Just conscious of the time, we've only got a few minutes left. Grant, if you are an investor at the moment and you've got some spare cash, what's your advice? No, not what's your advice, but what would you be looking to do right now?
Well, based on advice from Steve and Adrian, I'm going to go out and buy now. I'm going to snap up any property I can. I think my advice would be, if you are looking at buying, if you are looking at remortgaging, make sure you have a good team around you. So you're using a fantastic advisor through Impact, we'll haste to add, to make the right decision. Have a fantastic accountant and a fantastic solicitor in place, because it's you've got to look at not just, like I said earlier on, the short term, you do it on a bridge. That's not the right solution if it's not the right advice for the long term, if that costs more money. So you need to understand what your short, your medium, your long-term plans are for any investment you're looking to buy. So speak to all of the people before you start going down a certain route. That would be my bit of advice.
Thanks, Grant. Steve, tips for our audience, please?
Well, I think, as I said earlier, if the deal works, the deal works, whether there's a stamp duty incentive there or not. For me, I think the buy-to-let market is just set to thrive. If we look back through previous recessions, okay, this one's been caused by a pandemic, as opposed to if we go back to 08 with the US subprime crisis causing where we all ended up. But the fundamentals haven't changed. Through every recession, out the other side, demand for tenancy increases. It just does. It's a sad byproduct of economic hard times. That's still true today. So I would say that the fundamentals of the buy-to-let market are there. A lot of it's going to end up with private landlords simply because we don't really have a social housing policy in the UK that's going to be able to cope with really just people having somewhere to live.
Brilliant, thank you. Adrian?
I think they need to speak to the award-winning advisor that's won an award in buy-to-let in my bottom right-hand corner. So, you know, speak to people like Abbie. Look, there's plenty of choice out there. You've got 3 really good specialist lenders that have been on here today telling you what we can do. There's plenty of opportunity. There's plenty of choice. But it is about getting the right deal. And it might not always be that it's the cheapest deal. You might want the quickest in terms of service, the most flexible in terms of criteria, or the most appropriate in terms of the structure for the asset that you're buying. And, you know, people like Abbie are very well placed to give that advice. And, you know, as lenders, the 3 of us on here, I think we only allow business through intermediaries. So that's a really key part of the channel for me.
Thank you, Adrian. Abbie, last words to you.
I think it's to do your research, know your market, and seek the best advice. Yeah.
Brilliant. Thank you very much. Really appreciate all of your time today. Thank you for giving it to us and giving us your tips and recommendations on the questions I've been firing at you. Appreciate it. And thanks to the audience for watching. We have recorded this, so we will be posting it out on an email shortly. In the meantime, please do get in contact with us, with Abbie, myself, on Impact's website. All the telephone numbers on there and how to get hold of us. In the meantime, keep well and stay safe. We'll see you soon.